A British island with 65,000 people hosts over $1.3 trillion in financial assets, more than most nations' entire GDP. The standard story is straightforward. Bermuda is a tax haven because it has low taxes. Companies incorporate there, park money, pay less to governments, and everyone involved gets richer. It's simple supply and demand. Small island, business-friendly laws, no income tax. That's the accepted explanation. And it's not wrong, it's just incomplete. Bermuda sits in the Atlantic, roughly 650 miles off the coast of North Carolina. It's tiny. The island measures about 22 square miles, smaller than Manhattan. Yet today, nearly 15,000 offshore companies are registered there. Insurance companies, reinsurance firms, investment funds, holding companies. The sheer density of financial infrastructure on this speck of limestone is the first clue that something deeper is at work. The story most people know begins in the 1930s. Bermuda needed revenue. Tourism brought some. But the real pivot came after World War II, when the island's government realized it could offer something no one else could, a legal jurisdiction that asked almost no questions and taxed almost nothing. That's the conventional timeline. But the mechanism, how it actually worked, is where the system reveals itself. The key wasn't just low taxes, it was legal opacity. Bermuda created corporate structures that allowed wealthy individuals and multinational firms to own assets, earn income, and move capital across borders while keeping the beneficial owner, the actual person or entity profiting, hidden behind layers of corporate shells. One company owned by another company owned by a trust, registered in Bermuda, with no requirement to disclose who ultimately benefited. But here's where the accepted story breaks down. Bermuda didn't invent the system alone. The real story starts in the 1950s and 60s when major accounting firms and law firms, based in London, New York, and other financial capitals, realized they could use Bermuda as a tool. These firms designed the structures. They marketed them. They brought the clients. Bermuda provided the legal permission. The system worked because of a feedback loop. Once a few major corporations set up in Bermuda, others followed. Once the infrastructure was there, lawyers, accountants, registered agents, trust companies, it became cheaper and easier to incorporate there than anywhere else. The cost to establish a shell company in Bermuda dropped. Competition between service providers drove prices down. Bermuda's advantage compounded. By the 1980s, Bermuda wasn't just a tax haven. It was the reinsurance capital of the world. Hurricanes, earthquakes, catastrophic events. The risk was being pooled, priced, and traded through Bermuda-registered companies. A natural disaster in Florida would be underwritten by a Bermuda insurer, which would reinsure the risk to a London syndicate, which would lay off pieces to Bermuda-based funds. The island became the nexus of global risk transfer. This is crucial. Bermuda's dominance wasn't inevitable. It was built, and it was built by a specific network of actors: offshore law firms, multinational banks, accounting partnerships, and crucially, the Bermudian government, which actively protected and expanded the system. When other jurisdictions tried to regulate or tax their own citizens' offshore holdings, Bermuda's government pushed back. They lobbied. They made political alliances. The real explanation emerges around the 1990s and 2000s. Bermuda didn't succeed because it was small or isolated, or because it had low taxes. It succeeded because it became embedded in the global financial system at a critical node, the point where wealth gets hidden, risks get transferred, and tax obligations get minimized, all within the law. What makes this system predictable is its own logic. Once Bermuda became valuable, governments and multinational corporations had incentives to keep it valuable. Wealth holders wanted the secrecy. Corporations wanted the tax efficiency. Service providers wanted the fees. And Bermuda's government wanted the economic activity and the political autonomy that came with it. All parties benefited. The system was stable. Implications ripple outward. When wealth can be hidden and taxed nowhere, governments lose revenue. When corporate profits can be shifted to low-tax jurisdictions, the tax burden shifts to ordinary workers. When risks can be obscured in complex structures, it becomes harder to see systemic vulnerabilities. The 2008 financial crisis didn't emerge from nowhere. Warnings existed. Bermuda-registered vehicles held trillions in mortgage-backed securities, credit derivatives, and other instruments whose true risk was obscured. Today, Bermuda still hosts over $1.3 trillion in assets. The structure persists. Some transparency initiatives, FATCA, automatic information exchange, beneficial ownership registries have added friction, but the core system remains. The incentives haven't changed. Wealth still wants to hide, corporations still want to minimize taxes, and small jurisdictions still want the economic power that comes from offering these services. The Bermuda Triangle of finance isn't a mystery, it's a system, and systems don't collapse by accident. They collapse when the incentives that hold them together fracture. Watch for the moment when governments stop tolerating offshore structures, or when the risks hidden inside them become too large to contain. Until then, Bermuda's financial dominance will persist, not because of geography or luck, but because the logic that created it is still working. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you want to understand how financial systems actually work, the real incentives, the feedback loops, the moments when they break, subscribe. There's a new case every week. Subscribe, there's a new unsolved case in finance every week. This video is for educational and informational purposes only and is not financial advice. Always do your own